Introduction. The purpose of a Treasury Department. The Treasury Department of a company is responsible for the management of the company's cash, investments, liabilities, and working capital. Their main purpose is to ensure that the company has sufficient cash on hand to undertake its operations across all its divisions. Good treasury teams go a step further and aim to maximize the efficiency with which a business manages its assets and its liabilities. Efficiency can be enhanced by reducing the company's cost of capital employed or by maximizing its return on capital invested. These concepts would be explained in more detail in the next section of the course. How do treasury departments maximize the return on capital for a business? Firstly, they manage working capital. Treasury teams endeavor to optimize the terms and conditions upon which their businesses interact with suppliers and clients. When cash is in the hands of external third parties, it creates an opportunity cost for a business, in that the same cash cannot be deployed within the company to achieve the objectives of management. In order to optimize internal cash management, treasurers need to negotiate the payment terms of suppliers and customers. The demand for much-needed working capital can be reduced by reducing the time that finished goods remain on the company shelves. This is idle capital and is best handled by an operations division. Reducing the time taken for clients to pay for delivered goods, avoiding the company having to source capital from other areas in order to continue operations while waiting for clients to pay for goods and services already delivered. And finally, by reducing the pressure on the company to immediately pay for raw materials or external services from third-party suppliers. By deferring or spreading out payment terms instead, in such a way that no additional costs are incurred by the business. The last 2 points above would be the responsibility of the Treasury Department. Secondly, central cash pooling. Treasury teams are also responsible for the redeployment of excess cash within the organization through central pooling. Treasury departments make sure that departments that need cash have it when they need it, and that those departments that don't need cash do not sit on idle cash balances for too long. Thirdly, preparing forecasts and budgets. Treasury teams ensure that relevant departments can adequately plan ahead and that external funds raised are sufficient for the forecasted needs of the business going forward. Furthermore, this role is also responsible for final sign-off of historical financial performance, which would need to be reported to shareholders and various stakeholders of the company. Fourthly, assessing the capital structure of their businesses. Treasury teams need to make sure that their businesses operate at optimal levels of debt and equity, and that debt and equity funding are negotiated on the best terms possible. Fifthly, asset management. Making sure excess cash is invested in the most profitable risk-appropriate manner. Deciding on whether to recover, write off, or discount potential bad debts or receivables, depending on the cost-benefit considerations. Sixthly, risk management. Treasury teams aim to minimize the occurrence of financial loss in a company. They do so by putting suitable mitigants in place for the following risks. Operational risk. The risk that internal processes are followed incorrectly or that company policy is not adhered to. A Treasury team's responsibilities regarding operational risk would involve areas governing taxation, accounting, and audit. Credit risk. The risk of customers failing to pay for goods or services delivered. Credit checks should be performed by the risk division of a company in conjunction with the Treasury team to ensure that credit or deferred payment terms are only granted to clients with suitably low default risk. Market risk. The risk of external economic factors such as exchange rates, interest rates, commodity prices, etc., causing increases in costs or decreases in revenue. Treasury teams formulate hedging strategies to mitigate adverse movements in external economic factors. We will analyze each of the Treasury functions above in the chapters to follow.